Okay. Good morning, everybody, and welcome to the next in the series of webcasts from Asset Finance Connect. Today's topic is increased asset specialization the way to improve returns for asset finance lenders? And we've got a great panel, and let me please introduce to you the panel that we have today. First is we have Ed Thompson, who's the General Sales Manager from John Deere Financial, who are a captive, or that's how we're terming you. Ed, you can tell us whether that's correct or not later on today in the webinar. The second is we've got Steve Bolton. Steve Bolton is the Managing Director UK of PX Solutions, who's a private equity funder. And the third is Graham Lyons, and Graham has been telling us he's not been well. He's had food poisoning, so we're very grateful that you made it today, Graham. And we will be gentle with you, I promise. Graham's from Novuna Finance, who's an independent lender. And last but not least, we've got Jason Hurwitz from Netsol. Jason was a lender. He worked for Aldermore, a challenger bank, but he's now a technologist and works for Netsol. Netsol are the sponsors of today's podcast. And today's topic was Jason's recommendation. So welcome, everybody, and thank you, Jason, for the topic, and thank you, Netsol, for the sponsorship. So when Jason and I were doing the pre-work for this webcast, we had a very interesting discussion about the definition of specialization. I had the initial view that to be a specialist, then a company could operate essentially only with one business stream. But Jason, on the other hand, felt that a company with multiple business streams could be a specialist. Jason had a very convincing argument on this point, and I'm sure that we'll hear that today during today's webinar, Jason. I'm sure you're ready for that discussion, are you not, Jason?
David.
Can you hear me?
Yeah, can you hear me?
Okay, great. Okay. To kick things off, I thought it'd be interesting to hear from each of the panelists what they think specialization means in the context of their business and whether they believe their organizations are specialists or generalists. My suspicion is that they will all claim to be specialists, but let's get started and we'll find out whether I'm right. So first, Ed, can we come to you? As John Deere's captive, I guess you see yourself as a specialist. John Deere's focused on the farming sector and sells a range of farming assets. And what's your view? Does John Deere see itself as a specialist, and what does a specialist mean in this context? And I must tell you, I've got not a conflict. I do own a John Deere garden tractor, so I'll be looking forward to what you have to say about that.
I'm not going to disappoint you. I believe, yes, we are specialists. Yep. I think, one of our taglines is that we're committed to those that are linked to the land. So specialization, for me at least, is defined by the breadth of the customers that we serve. We work in one field, if you pardon the pun, and understanding those customers, their pressures and problems, and developing solutions to specifically meet their challenges is our purpose. And I think that's my definition of specialization.
Okay, but you've got lots of different types of customers. You've got me as a customer who's obviously a domestic customer, and then you've got probably massive farming conglomerates all around the world who are also customers as well. So it's a very wide spread of customers that you have.
Yes, yeah, indeed. We've got customer segments within our definition, yes, but I wouldn't say we were necessarily generalists.
Right. Okay. Great. So thanks for that introduction, Ed. Graham, can I come to you next? I think at Asset Finance Connect, we described Novuna as an independent asset finance lender, and I did talk to Edward about this, and we thought about Novuna as being a generalist because you provide finance for lots of different types of assets and for companies working across lots of different sectors. But your website indicates that you have several specialisms. So same question to you. Do you consider yourself to be a specialist or a generalist? And what does that mean in the context of your business?
I think my first answer would be a generalist, but I think what we mean by specialised will mean different things to different people. So at Novuna, from a group perspective in the UK, we've got quite a lot of diversity, from consumer loans, fleet management, cash flow funding, and of course the division I work in, business finance. And they're all different. There are some similarities, but they're broadly different, and our structure within our teams and our allows for that specialisation. And within business finance itself, I suppose the kind of more generalist end of the spectrum, you might argue, is kind of generic hard asset HP lease that a lot of us in the market will do, perhaps in a similar way to John Deere in the agricultural space with a pretty straightforward loan product. But then at the other end of the spectrum, we've got a stocking business line, block discounting, and then project and sustainable finance, which in my business, in my world, are certainly more specialists with dedicated teams focused on that, with specific skills. So I think it varies, and it depends on the experience, the knowledge that each business has got to kind of manage each of those lines to define whether or not they may or may not be viewed as specialists, I suppose. Okay,
so what you're saying is you see yourself as a generalist, but you've got these different business lines, these different silos, and each of those silos, do they have absolutely a dedicated, discrete team that just works within that silo, and they don't swap over into anything else?
From a group perspective, yes, they're very distinct business divisions with specific teams, specific systems, and they have built the knowledge and expertise in their chosen sector. And within business finance itself, that's broadly repeated, less so because we're using the same sort of core platform and a lot of the similar core teams. But within it, certainly if you look at something like our project finance business, that's something we've built over recent years. That is a specific team. It's a very, very specific set of skills and products that we hadn't offered before, and is very, very different from what we might call our more generalist, bog standard HP lease business. So yes, we do kind of have focused teams supporting most of those business lines.
Okay, well, we'll look at that later on in the webcast, whether that's an efficient way of doing business, whether that's, whether that increases or reduces risk. We'll look at all those things during the webcast. Great, thank you. Thirdly, Steve, can we come to you? Steve's from PIAC. You're a private equity funded lender, and I know, like all lenders, you've got a complex business which can't be neatly pigeonholed. And like Graham, you work with brokers, dealers, and manufacturers. But a material part of your business, I believe, is as a vendor finance partner. So in that way, it kind of makes you a bit like Ed, a bit like John Deere, and then another way, it makes you a bit like Novuna. So Steve, are you a specialist or a generalist?
Well, we're a financial services business generally, being more specific. So a specialism debt finance, B2B debt finance. And our channels to market, you're right, our broker, our vendor, and we also have a direct business here as well. And this is my one opportunity to correct your pronunciation to Peak rather than PIAC, which
Peak. Okay,
a number
thank
of
you.
colleagues on the call will find very amusing. So I would consider us a specialist in a number of different areas, like most of us. I think specialism is about focus, but it has to be about driving value for all parties around that focus. So if it doesn't turn into expertise, I'm not sure it's anything other than window dressing. So expertise is really where we're trying to get to, expertise in the customer's business and an understanding of what our product set can do for that customer.
Okay, but with all those different routes to market, are you a bit like Novuna? Do you have specialist discrete teams that deal with those things, or are you?
So we do, yes, we do. So whilst we're all part of a wider team and we draw on each other's strengths, and certainly one of the benefits of being larger is what scale can bring in terms of efficiency. Because some products are more expensive to bring to market, some products have a greater cost to serve. But with scale, you can level the playing field to some degree on that front, and therefore look after customers where they need to be looked after rather than where you think they should be looked after.
Okay, so there's a couple of similarities between Novuna and Peak.
Yeah.
So I was going to ask you about that before we started, actually, about the pronunciation, Peak. And I think the similarities there are that you both consider yourself to be generalists, but within that generalist banner, you have discrete teams that are looking after different parts of the business.
You have to have discrete specialism to drive expertise. Otherwise, you're not going to, in this day and age, not going to add the value that either an introducer, a vendor, a broker, or a customer, if you're dealing direct, expects.
Okay, brilliant. Okay, and I think that really leads us very nicely into Jason. So Jason, you're an ex-lender working as a technologist, but the lens nonetheless works for NetSol also. NetSol has a technology platform for equipment and asset finance that's called NetSol Transcend. In technology terms, NetSol Transcend is certainly a specialist solution as it's been designed just for the industry, but it's not quite what lenders mean when they talk about specialization, I don't think. So why, Jason, do you want to talk about specialization? What's the proposition? And are you a general asset finance tech solution trying to serve an increasingly sector-specific set of lenders, or is there some sense in which you're able to be a specialist tech provider serving individual segments within the asset finance industry with specialist solutions, but within one platform? So, a long question, but perhaps you could answer it.
Yeah, it's a long question. Yeah, I guess we'll cover off some of it in this answer, and as we go through the webcast, I guess that's sort of fundamental to what we're all talking about. As you said, I worked in the lending industry. So when I worked in Close Brothers and in Aldermore, we spent a lot of time focused on developing deep industry sector specialisms. And that's what we mean by specialisms in this space. But doing it to varying degrees, but always looking at it as a source of competitive advantage. And this is now something we brought into the NetSol Transcend platform, which we can speak more about in a bit. But in some cases, that specialism is an entire front to back team, from sales to risk to ops, where everybody's aligned to an industry segment. They understand the customers, they've got the expertise, they understand their businesses, and they're tuned in, importantly, to what the sort of normal nuances are in each of those industry sectors, and they tailor their approach around it. In other segments, it can be enough to have sort of sales, support, credit, and asset management all aligned. And then in that sense, you get sort of fast in commercial RV setting, which then leads to sort of a good commercial model, a strong credit appetite. And all of that's kind of aligned to an industry sector with, I think to Pete's point, with genuine, authentic expertise that's visible to customers. It can be really easy to forget that SME customers are business owners that eat, sleep, breathe nothing but their business and their industry sector for 6.5 days a week. I was an SME owner myself and had a bunch of asset finance contracts. I get this implicitly, these businesses are their babies. It's their identity. It demands blood, sweat, and tears over many, many years to build, create, maintain, and grow them. And they know when they deal with authentic expertise, and they can smell a fake a mile off, because this is all they do. So of course, you can get, a generic and very quick yes credit decision. Then everyone kind of likes that. That's great, but they'll be loyal to that sort of yes rather than loyal to you as the lender. So for any customer that's not sort of highly automatable and you can get a really quick yes decision, then the last thing that SME customer wants is a barrage of generic questions that are unrelated to their industry and industry sector, and that will alienate them and alienate you as a funder. Whereas when they get funders who get them, who really understand, then and provide a sort of premium service to a particular industry sector, then there's a real opportunity to command a premium price point alongside that service. And then there becomes a kind of a healthy value exchange. But the trick is, I think, how do you set up and deliver a genuine specialism or a set of genuine specialisms and do that at scale without loading punitive op costs that damage your returns? Because, and that's where tech comes into this, and where the NetSol platform fundamentally plays a role, because we've set it up in such a way where you can build multiple customer journeys highly tailored to different customer segments and run them simultaneously in one platform. And by that we can then help businesses sort of scale up specialized businesses.
Okay, well, I think we're going to cover pretty well all those things that you mentioned there. So, I think what I'm hearing there is the NetSol system's modular. It's got sales, risk, collection, RV, and so on and so forth. And and you kind of design that around delivering what I think you termed authentic expertise. So I think there'll be plenty of opportunities, Jason, to explain that during the course of the webinar, and we look forward to hearing more about that. So thank you very much indeed, everybody, and that's our kickoff. As usual, now we're going to run the webinar into three topic areas, and my colleague Rosanna will start each topic area by posting a poll question, and also she'll keep an eye out for questions from the audience. We love questions from the audience, and so please send them in, and we'll try. We've got a great panel today, and we'll ask the panel to answer those questions live, as many as we can. So please don't be shy and send in those questions. So the three topic areas we're going to talk about is, the first, we're going to consider the strategic case for specialization. Secondly, we're going to consider the competitive advantages of specialist ecosystem, ecosystems, including routes to market, remarketing channels, and of course the important relationships with manufacturers. And thirdly, we're going to consider how asset finance, vendor finance, and captive lenders will or should change in the future. A little bit of crystal ball gazing to finish off the webinar. So Rosanna, can I ask you please to post the first poll question?
You can indeed, David. So our first poll question is, does specialization predominantly deliver opportunities or threats for the asset and equipment finance industry?
So there's half a dozen answers there. So we'll leave everybody to have a think about that, and we'll crack on with the webinar. So today we're going to evaluate whether specialization or generalization is a useful distinction. And as the poll question shows, we'll start by considering what the opportunities and threats are that come from specialization. Then perhaps we can consider whether there are some instances where specialization is better, and others, in fact, where it might not be. So Steve, can I come to you first? When we had Bill Stevenson on our panel at the European Summit last year, he talked generally about low margins and the need to raise them. He talked about charging more, which would certainly achieve the objective, but may well end up with losing market share. But he also talked about increasing margin by taking more residual value risk. And what did he mean, and how do you do that? And in fact, Jason mentioned residual value risk as well in his opening statement. So is RV a competitive advantage? Is specialization a prerequisite for getting margin through RV management, or can the generalist do it as well? Maybe helped by Jason's technology. So if you could take that one first, Steve, please.
So let's look at it in the round. It will obviously help you originate more if you start with a higher residual value, but if that's not grounded in reality and expertise, then I'm afraid quite quickly the party will finish, and with it your business not long after. I think this is a really important part of specialization, is driving expertise that goes deep into the business, but is also broad. So it's not just having a salesperson who speaks the vocabulary of the vendor or the customer and understands, you mentioned John Deere, the seasonality of the usage of a product like that, but also considers the risk profile in that particular market and the broader impacts that the economic environment has over time and through the cycle, to enable you to set a residual value that you really can run your business on. And clearly, residual value is not just about setting a number that you are confident you'll be able to realise and write business initially, but also realise when you come to dispose of that asset, but also recognises any secondary market against that asset, and indeed likely customer behaviour at a portfolio level.
Yeah.
So it's not just a question of putting a number in that helps you win a deal. It has to be something that is sustainable through the economic cycle of your business.
Yeah, I mean, setting residual value, it's not a one-off event, is it? I mean, I've got a lot of experience of setting residual. So you set the residual value at the start of the contract. How do you manage that? How do you revalue that residual value through the life of the contract? How do you see potential problems, and you might want to get that equipment back and so on and so forth? How do you deal with that after you've actually signed the contract?
Yeah, it's not fire and forget. It might be in an absolutely ideal world, transaction by transaction, but even that is rarely the case, except with the very, very best of credits, with the very, very stable strategic plans. But having the ability to effectively mark to market your book at any point in time is critical for you to manage your ongoing risk position. And not just that, also be able to course correct. It's not an exact science, so you need to be able to course correct. There's very good examples of that right now in a very well understood asset class, which is vehicles. There was a view of an electric vehicle 2 years ago that's very different to the one that the market has today, and that's a market that has evolved. There are not many vehicle contract hire companies financing electric vehicles with the same appetite for RV that they had 2 years ago today.
No. And even within EVs, you've got brand issues as well, like Tesla is obviously.
You have at the minute, haven't you?
Yeah.
Yeah. So that knowledge and expertise, it has to be deep and broad, but it also needs to. I think this is where having people within the business who see the business through the cycle is also very important. So expertise is something you lean on very heavily. We all lean very, very heavily on in this industry, and it's important that trust is maintained, and that comes with longevity.
So what you're saying there is, that specialization is really important. You need to understand the market and so on and so forth. But Jason, can I come to you and really ask you to maybe challenge what Steve said, because there's a lot of technology out there that purports to be able to predict a residual value. And if that works, does that mean that those specializations that Steve talked about become semi-redundant because they can be replaced by tech, or is knowledge and experience still going to be important in managing residual values?
Thanks, David. I might disappoint you and say I'm not going to particularly challenge Stephen. In fact, I'm going to agree vehemently in that. I mean, I guess to split your question a little bit into two pieces. Can tech help deliver a more accurate RV prediction? Short answer, yes. Of course it can. The longer answer is it's only part of the solution. And there needs to be sort of the key ingredient that goes alongside the tech is the wider strategy and proposition, which does include tech, but also data, policy, relationships, and human expertise. In some sectors and asset classes, like you mentioned, David, the future values are a fairly easily accessible data point. You talk about vanilla cars, leaving EVs out for a moment. It's quite straightforward to go and pull this data from CAP or Auto Trader, apply an RV percentage that suits your appetite. And clearly you need tech to make that API enabled and super easy to orchestrate. You can pull that into the customer journey and run it really smoothly. But in less vanilla asset classes, the data isn't yet really easily aggregatable in a single source. Certainly not ones as mature and accessible as CAP and Auto Trader. So in those examples, I'm going to agree with Stephen, is you need genuine expertise in order to, with proper industry understanding, who understand the asset classes deeply. They know which assets are in demand and which ones aren't. They know what's happening with supply chains. They know the current valuations, and all importantly, I think Stephen touched on it. They know the disposal routes at the back end. So in the event of repossession or just a normal end of term, they know what to do with that asset, and they know how to realise the maximum value out of it. And that then plays into the confident front of market credit appetite that allows them to lend to that sector. So without these sort of key ingredients, you can't really provide genuine expertise. So tech only plays part of it. So at some point in the future, equipment valuations will be all online. I don't know when that will be, and maybe it'll be as accessible as vanilla cars. And then things like AI tools will be really useful in that scenario, because it'll be going to scrape all these sources, go to all the auction houses, pull out all that data, and say, yeah, this is probably the best value of that. A piece of equipment right now, but until then, until that data is available and reliable, then lenders have to rely on human expertise of experts and asset management teams who live and breathe the assets in order to set the right RV position. And tech is just a way of actually deploying that opinion in a really sort of efficient way. But to your second point of, does tech remove the competitive advantage? I don't think so. Because I think you need tech is the enabler, to coin a really old phrase. It's the expertise to tell the tech what to do that creates the competitive advantage. So expertise is still the key ingredient that the lenders need in order to tailor a proposition and tell the tech what to do.
Okay, well, so that's an encouraging answer, Jason. So so you're saying tech is an enabler, it enhances, it supports expertise, but it's not a replacement for expertise. No. Okay, great. Graham, can I come to you next? Talking about maybe just move slightly away from residual value, but talking about your specialist divisions. So when in your opening note you said you've got these specialist divisions. How important is it in those different divisions to have what Jason was just talking about there, and also what Steve was talking about, specific knowledge of the people in those specialist divisions, and how important is having the right people versus having the right tech to deliver into those specialist divisions?
I think I'm probably going to echo what everyone else has been saying to a large extent. And I kind of take a step back initially, which I think there are probably a number of key aspects that might define a particular funder's proposition, and in combination are probably seen to define whether it's more or less specialised and how much of a different skill set to support that you need. And some of my colleagues have mentioned this in terms of the products that we offer. So you've got a loan at one end of the spectrum, arguably, and then not least perhaps at the other, or some of the sort of project funding that we do. The markets in which you operate those products, whether it's consumer, and I know we'll touch sadly slightly on regulation later, and that has an influence over kind of what we do. The route to market, whether it's direct, brokers, vendors, the assets that we're funding, and as we've talked about, sort of credit appetite and all of that leading through into price and that service point for the customer. So I think our ability to compete and provide value to customers and succeed in those sectors comes from understanding all of those key aspects. It comes from understanding the needs of our customers and a deep understanding of all of those other aspects interplay with each other to provide that overall proposition. And as Steve was alluding to, you get any of those wrong, you won't succeed in the long term, whether that's through bad debt or poor service or poor brand reputation. So having specialised business units and teams means we can build and maintain that knowledge, experience and expertise, so that the business overall is more successful as a result. And if you don't have that, you're undermining your proposition in the market.
Yeah, so we're getting the same theme there, is that tech's important, but actually having the right people, the right expertise is probably certainly as important or possibly more. So Ed, can I come to you for a final question in this section? And you're obviously a captive, you only deal with John Deere products. So I'd like to talk to you a little bit about specialization. I'd like to talk to you about whether that introduces concentration risk and whether you can do anything about that, whether you can defray that risk, whether you can share it, and so on and so forth. So you've got concentration risk in one area, which is mainly agriculture, I guess, and then you've got concentration risk definitely in the product because it's John Deere product. How do you manage that? How do you manage those specialist risks that a captive has?
It's an interesting discussion, isn't it? And Jason touched on it just then. We don't have a cap guide for values for tractors. We don't have sort of market data. One model of tractor can be twice as much value as a similar model of tractor with different specifications. So you become very, very reliant on what is actually our route to market, which is our dealer network. And that partnership is the key partnership for me. It's a strong partnership that we have. It's vital for us. It's vital for them as well, because here we are supporting them to sell at the top, but we're also asking them to be our disposal agents as well. And I think that opportunity to work with the dealer network for disposal is where we try and manage our concentration risk. I think I agree that we sell in a very restricted way, but we're here to support our dealer network as well, because we want those businesses to work as well, because that's where the customer makes the touch point. And I think ensuring future residual value price and value, and ensuring high residuals, because that's what helps us sell. That's a two-way shop. If the dealer's disposing, then we're happy to go up with our residual values and vice versa. So I guess that's the key to the defraying the risk a bit. I think also it comes to the comment there that Graham made, is deep customer understanding. We know our customers very, very well. We know the sector of farming they're in. We know the seasonality of that business. We know when to pull that asset out and when not to pull that asset out, more importantly. And I think these things and this very specific knowledge helps it all turn around.
So do you think that specialist knowledge that you have about, even depending on the equipment fitted to a tractor, does that help you? How does that help you manage residual value risk?
There are macro factors involved for sure, but knowing how many specific types of tractor for arable operation are on your book versus livestock tractor are on your book allows you the opportunity to work with dealers in different ways for different types of customer. So a residual value in one sector of farming could be different from another. So you're in that. Yes, technology can support you in that, but there's a lot of knowledge in there, and there's a lot of playing off the used equipment sellers in the dealer network as well. So that's where the opportunity lies.
Yeah, and I think that's a really nice introduction into the next section, actually, there, because you've introduced another factor, which is the dealer. And obviously, I'm not saying brokers aren't I mean, brokers, when they submit the deal, they have an interest in the deal performing, but they're not, generally speaking, they're not involved in the remarketing and the circular economy. So we're going to come on to that in the next section. So Rosanna, can I ask you to give us the results of the first poll question and then post the second poll question, please?
So our results are 36% predominantly opportunities, a bit higher on more opportunities and threats at nearly 44%, about the same, 13%, more threats than opportunities, 7.7%, and no votes for predominantly threats or unsure.
Okay, great, thank you. Could we
next poll question.
Could we post the second poll question, please?
So manufacturer captives have a significant competitive advantage because of their relationship with the manufacturer, which other lenders cannot replicate. Agree, disagree, neutral.
Okay, great, thank you. Ed, can I come back to you and continuing the theme from the poll question and the last question that we talked about? The captive relationship with the manufacturer is really important, and I have a long background in captive operations. And do you think, how big an advantage is that versus the independents being a captive? How do captives make it difficult for independents to encroach on their market?
So for me, I think collectively we've got one goal, and I think, and that's a simple goal: sell more equipment and services. It's not necessarily about selling asset finance or making finance margin. It's about selling equipment. So by that I mean all of our internal teams, including our finance team, align to that ambition. All our branding, all our go-to-market activities support this. And this common purpose, I think, offers clarity to the customer at the end. They're buying from John Deere, but they're buying and financing from John Deere, and I like to think that they often think that that's one and the same thing. And I think for me, everything we do around all our activities is underpinned by this common, simple, straightforward goal. I don't think it gets much more sophisticated than that. I think, if you've got your product right, if you've got your brand messaging right, the customer is buying John Deere, not necessarily buying finance from John Deere. They're buying and acquiring a tractor or a combine or whatever.
So you've got this cradle to grave, you've got this, brand consistency all the way through. Does that mean you can get a higher margin than an independent?
I don't think that is necessarily our goal. I think John Deere makes money by selling equipment, and I think I'm not saying that it needs to be a wash in the finance department, if you like. We've got to more than wipe our face, but the idea that we're there to lift the rate, extend the term, and do all those tricks to keep people in finance, it is not necessarily about that. It's about providing the access to our products and services to the customer. I think it's a completely different approach.
Okay, so about different approach, Graham, can I come to you now? So Ed's talked about there that he sees his job is enabling John Deere to sell more stuff, and maybe margin is important, but it's not primary, it's secondary. But if you're dealing with brokers, then margin is very, very important for them, and it's very important for you as well. So how difficult, or how do you challenge the business model of a captive when you're reliant on broker businesses who've they've probably got a different mentality, and they've got a very different structure to their business?
Yeah, I mean, I think it's in a direct sense, it is difficult to challenge the captives when you're talking about from a funding perspective, in terms of, as Ed said, it's not necessarily about the rate and the return in the same way as it will be for us in terms of funding a particular tractor. So they've definitely got as you'd expect, a step ahead of us. I think from a broker channel perspective, then yes, it's different. It is very rate driven, but I think equally, we've got sector specific brokers. We have got specialization in the broker channel generally. We certainly have a broad brush if we look across our business, the segmentation between ag brokers, motor specialists, technology, media equipment, and quite a lot of specialization there. So I think brokers do understand the markets in which they operate. They do understand the assets generally that they're funding. And as we all know, a lot of those guys and girls came out of funders previously, and they've left with years of sector and product and asset specific training, and they understand the financial products that they're selling to support those assets and support those customers. So I think that brokers definitely have a part to play, but it is, as you say, a different dynamic between that proposition to the customer from us as an independent via a broker and a captive, definitely.
Yeah, talking about the background of brokers, when we were doing the research, somebody said it's easier to teach a farmer about finance than it is to teach a funding specialist about farming. So would you agree with that statement?
I don't know, really. I think that, as I said in my previous answer, that historically, I think there's a really strong backbone in our industry from brokers of having that expertise and having that knowledge. So I don't particularly see that as a huge issue as we kind of sit here today. I think there's a potentially, as we go forward, there could be a risk that as the kind of demographic base, if you like, of the broker network starts to change, that we run the risk of seeing a dilution of that specialization. from kind of new entrants into the market. But that's probably a bit of an overly stereotypical way of looking at it. But it is something that is potentially a risk as we go forward, as some of the experienced hands kind of potentially leave the market. But no, generally, I think brokers very much understand the markets in which they operate.
Okay, so Jason, can I come to you now? So we've got a few questions coming in, and there's quite a few linked to whether specialization equals better margin opportunity. We've heard from everybody that they feel that specialization means knowledge about the equipment and about the industry and particularly the business segment as well. But we hear a lot about artificial intelligence now. How is that being used? Is that being used to enable more specialization, or do you think, Jason, is AI replacing specialization? Is it something that the specialist lender should be worried about?
It's an interesting question, isn't it? I mean, whilst the pace of innovation in Gen AI is moving at impressive speed, and we're still at absolute early stage infancy, you can quite quickly use Gen AI and put together a prompt to generate content with specific empathy to an industry segment to help you mimic a specialization. So, but frankly, that is, let's call it what it is. That's pretending. And the responses you get back are often they lack a depth and an authenticity that will be really visible to a genuine industry expert, which then risks kind of alienating and not attracting those customers if you want to provide that sort of authentic expertise. Some might do this and they might have some success in winning easy business in a particular segment with the pricing alongside. The problem is with easy business is a lot of people can do it and therefore it's very competitive, and it's not particularly, with the laws of economics, it's not particularly high returning. To have a genuine specialism means you need those front to back components of sales risk, relationship, channel partners, risk, credit appetite, tailored customer journeys, operating teams who empathize with sectors, in-life portfolio management that understand normal risk. And Gen AI can't solve for those things. So can AI solve this? No, not really. It can play a role, but it's not going to be the solution to bring specialization to everyone at this stage. So if you want to be known for a specific specialism with authenticity, and like we said it before, the first thing you need is human expertise that has deep understanding of that customer segment outside in, and you can then use that human expertise to design a proposition. And that's where it is. So we can use AI to inform our thinking, to come up with ideas, and that's great, but it's not going to do it all for us.
No, that's a really interesting quote, Jason. I do agree with you that if it's more retail, if you're buying a 3-piece suite or a car or some kind of domestic appliance, then AI and chatbots and so forth probably pretty useful. But when it comes to getting the right tractor and the right equipment and the right bits and bobs on it, then it's probably that's where you need it. And I think the word you used was authenticity. That's where you need authentic knowledge. So again, I think that's encouraging for the industry. But final question in this section, Steve, can I come to you? So you work with a number of vendor partners. We've heard about how the relationship with the manufacturer is hugely important from a John Deere perspective. If you've got multiple vendor partners, can you replicate that kind of advantage of working closely with the manufacturer, or is the product you end up, because you've got multiple vendor partners, do you end up delivering a more vanilla style product?
I think there are some practices and processes which are very transferable. So you can learn it in one area and transfer it across, or you can roll it out. A system change, for example, a system enhancement can hit everybody at the same time in a way that benefits everybody at the same time. So I think, just to come back to, scale again. Scale is important here because we are all operating in very competitive markets. You can open up a market these days that you think you have some sort of exclusivity in and build some expertise in, but our market is such a small one that very quickly that replicates. So being able to take advantages from and learns from one vendor partnership and apply it to another, it is a way in which we can differentiate ourselves. And that needn't necessarily be, from one, to use a farming, the farming industry, that needn't be from John Deere to Class. That might be from John Deere to a completely unrelated asset class, but where some of the underlying principles are exactly the same. And I think we've seen that come to life in the last 6 months. I'll say, sadly, the Court of Appeal judgment caught a lot of people by surprise. And very quickly, those of us who were not farmers with limited expertise in finance found ourselves at the centre of and holding the knowledge base as it evolved very, very quickly. And we became go-to for those vendors. How does this impact our business? And yes, they had to triangulate in, if they were speaking to 2 or 3 funders, they had to triangulate into what it meant for them and take their own legal advice. But that was an example where we could very quickly add value for our both dealer community and our OEM community by being able to brief them on what we understood the impact was likely to look like.
Yeah, and that's a really interesting point. We're going to come on to the Supreme Court judgment in the last section, but I think the ability of the industry to educate its customers, I think, is hugely important. And Asset Finance Connect, we've been doing a lot of work. It's probably mostly around auto, I suppose, because that's where the kind of the focus has been so far. But we are very definitely aware that the issues that started in the auto market will spread out to other sectors of the financing industry as well. And we're doing a huge amount of work on that particular topic with Shoesmith. So I'd encourage everybody to keep up to date with what Asset Finance Connect are doing in that area. And again, we're going to come on to that now in the last section. So thank you very much indeed, Steve, for introducing us to that particularly difficult subject. So Rosanna, can we have the results of the second poll question, please, and table the third poll question?
So for our second poll question, just under 30% with strongly agree, closer to 60 with just agree. Neutral is much lower at 9%. Disagree at 4.7%.
Okay, so Ed, you had a very convincing argument there. You convinced everybody that captives are really important. So, but can we move on to the last section? Can I come first to Jason? We've heard a lot, Jason, about margin and price in the discussion, and we've had a lot of questions about linking specialization to margin. Oh, sorry, I've forgotten the third poll question, haven't I, Rosanna? Yeah, so
we can cover that now before you get started. Yeah. Yes. So the last poll question there, David, is the future of business lending lies in the development of high margin services around the asset servitized finance. Strongly agree. Neutral, disagree.
Okay. So just proves, Rosanna, this is live. So we can make small mistakes. So Jason, we've heard a lot about margin price, and a lot of the questions that have come in from the audience have been about that. The question to you is whether technology, doesn't it just digitally enable specialization, but it sort of democratizes it, and it removes the competitive advantage for a specialist by making specialization available to all lenders? And if that's the case, then it's not a route to increasing margin at all, is it? Or is it just enables all the competitors to catch up in a way? So, bit of a challenging question for you, but I know that you won't shrink from the challenge, Jason.
Thank you, David. Too kind. Hypothesis might have more legs in vanilla asset classes like cars, where strong credit customers, or to very, very strong credit customers, where the understanding and evaluation of specific assets is less relevant in the underwriting, and it's more about affordability. But for everything else, whilst tech plays a vital role in helping specialised lenders scale profitably, You still need someone with expertise that needs to tell the tech what to do. So the tech doesn't democratize in that sense. When we provide clients with technology, we don't give them a credit policy and an appetite. We give them the means to operate multiple scorecards and rules simultaneously, but we don't tell them this is how you should avoid loss, or this is where there's a white space in the market and you should be keener in your risk appetite. We give them the tools and the capabilities to deliver value within segments at a very low and efficient, low cost and efficient way. So someone needs to design the strategy and design the specialization proposition and the go-to-market approach, and identify where's safe to play and tailor the journeys and credit appetites and all that good stuff, and then configure the tech to help build that in a sort of robust, scalable business. And with that, there's no doubt in my mind that specialization creates a premium service for those customers. And with any premium service, if you do it right, you can command a premium price point. And customers, SMEs, will pay for that if you get it right. If you're fast, if you're tailored, you understand them, provide empathy, you're not high on admin, and you're reliable and you're consistent. These things have a direct line towards the price you can command and returns you can generate in your business, particularly if you can operate it efficiently. But it's relatively easy, to operate a specialism with low volumes, because you can kind of handhold everything through with a small group of experts. But it's quite a different conundrum to scale up a specialized business whilst sort of demonstrably being a specialist, and do that whilst delivering healthy returns. And that's where tech plays a really fundamental role. How can you scale up and specialize at scale? And for that, you need sort of tech that you can tailor to each proposition and run it side by side. So no, I don't think tech democratizes it. I don't think it makes specialization accessible to everyone. But it is fundamental to scaling up a specialized business profitably.
Yeah, but I think I agree with all of that. But you said when we talked previously, you talked about easy business and not easy business. So easy business, from what you've just said, we could say that's prime business, and not easy business you could say is maybe subprime business. But the other point you made there, you linked the investment in tech to volume. And if you're going to invest in tech, which is not cheap, whether that's Netsol or anybody else's, there's a significant investment. Are you saying that you can only invest in tech if you've got sufficient volume, and if you've got low volume, you're probably not investing in tech and you're more reliant on that human interaction? Is that what I'm hearing, or are you got a different argument?
Tech fundamentally creates efficiency, controls risk, and connects things together, right? So the most benefit for these things is where there's an element of volume where you can get a benefit of efficiency. If you're a business that does 100 deals a year, each of them 5 million quid a pop, then tech's not really going to have a great deal of benefit for your business, because efficiency isn't where it's at. You're hand-holding one of these deals, 2 of them a month or whatever, and tech isn't the answer to your problems. If you're processing 3,000 props a month and you're trying to write 1,500 deals a month, then tech and efficiency is incredibly important to generating a decent return for your shareholders and running an efficient business. So of course there's a line between these things, and it depends on the business segment you're in about how much tech is relevant to that particular proposition. And it's important to get the strategy right and be sort of outside in onto what does your customer segment need. In order to ask these kind of questions, you need people that understand that customer segment and are specialised in it, so they can. There are plenty of lenders out there that have got similar to Ed on have specialisms in agriculture, and they've got people in those businesses who understand the nuances and the different times of the year and the seasonality and how different farmers operate and what's needed within them, and they know how to operate in that space, and they design the front to back proposition to make that tailored to that market. If they provided the same proposition as they do for vanilla car finance to an agricultural farmer, then it's really going to jar, and they're not going to win, and they're not going to manage risk, and they're not going to demonstrate any kind of authentic expertise. So, yeah, it's important to have these specialisms.
Okay, thanks, Jason. So are you saying that, just final question to you, Jason, is that if you're a low volume specialist operator, then probably tech is not your number one priority, and if you're a high volume sort of vanilla, less specialist operator, then that's where tech is. And the question to you is, do NetSol offer solutions for both ends of the market, or are you just really?
It's not quite as binary. Yeah, no, I hear you. It's not quite as binary as that. So I think it's the conundrum is. Vanilla high volume is easy because it's all kind of commoditized, and you can build a machine and throw everything through it. Very low volume, high value, you don't really need tech in quite the same way because it's all human expertise and handheld through the journey and doing very, very low volumes. The conundrum is how do you deliver specialization at scale? How do you grow volumes? And there's always a tipping point where manual processes stop working or start hurting, op costs start really hurting your returns, so you don't have much positive operating leverage. So how do you scale up specialization business? That's the conundrum, and that's where highly configurable tech, and you invited me to do a little bit of a sales pitch here, so I'll take it. Yeah. Is highly configurable tech allows, like we've got in NetSol, is you can design not one customer journey that sort of fits everyone, jam everyone down it, and you kind of do an okay job for everyone, but not great for any one particular segment. You can run multiple customer journeys within one tech solution, front to back. Then each one of those can be tailored to a particular specialism, or any specialism that you have, whether it be agricultural, marine, or commercial vehicles, or manufacturing, or whatever. You can have all these different journeys that are adapted and tailored within one solution. That's a key aspect.
Right. Okay. So if any of the listeners or anybody in the audience are listening, then obviously you can contact Jason directly, or contact Jason through myself or a more detailed answer. So we've just got a few minutes left, and I'd just like to pose the same question to everybody, really. Steve introduced the Court of Appeal and the Supreme Court judgment. Regulation is becoming a really big issue for the industry. So I'll just come 1 minute from each of you. Maybe come to you, Graham, first. What's your concerns about regulation, and how in your business are you managing those concerns, and what plans have you got to handle whatever fallout there is from the Supreme Court?
Well, I suppose that's the first point. Lots of the questions I don't know any of us necessarily have the answer to until we get the decision from the Supreme Court, but importantly then the FCA's response to it. And I've talked about this before, that if we're talking about specialisation, I don't think it's a huge leap to say that providing regulated business is absolutely a specialism these days. It probably always has been, but more so because it's become much more expensive, more complex to administer and control, and leaves us open to far greater regulatory risk. So tech, as a way to kind of manage that and make that more efficient, is important, because all of that, that increasing cost makes it, making a sensible return on regulated business more and more tricky. So, we need clarity in the short term from the Supreme Court review. I think we would all support the fact that we need a full review of all the legislation in terms of a review of the CCA and making that a little bit more funder as well as customer friendly. It's a difficult one to answer. We're doing what we can in terms of everything over the last few years in terms of consumer duty, but I suspect, along with everybody else, waiting with bated breath to see what comes out of the court case and how quickly, depending what they come up with, we need to react.
Yeah, but you commented there about the differential between regulated and unregulated business. So maybe Steve, I'm not sure how much regulated business you do, but are you having a different strategy for regulated versus unregulated in your business?
Oh, I think we're weighting the same as everybody else is. We have a very small regulated book, very, very small. And I think the hard-nosed commercial eye would look at that and say, why are you doing it? One of the answers for us certainly is we're going to wait and see, because there may well be opportunities that are presented to us off the back of the Court of Appeal, off the back of the Supreme Court, and we don't want to lose that expertise we've got within the business by redeploying it at this stage. But I think, everybody will be doing the same thing. But that itself is becoming, navigating regulation is expensive and requires expertise. So we all carry that cost with every transaction that we do. Just one word on it, though: it is good discipline at the same time.
Yeah.
So I don't think there's anything here that we should be looking at and fearing beyond the existential. If we get past that, I think it should be positive for the future.
Okay, well, we could carry on for another hour with this particular channel, but we're coming towards the end of the webinar. So, Ed, can I come to you? I mean, as a captive, you probably have no option but to have regulated and unregulated business in your portfolio. Do you echo the sentiments of Steve and Graham, or are you taking any kind of different actions?
No, very much so. I think we need to maintain an offering. We need to be able to ensure that we can finance that type of customer. I think the other aspect for me is that I've got a brand to protect, and that's John Deere's brand, which is a big global brand, and I can't be seen to be, shortcutting or trying to trip around consumer duty or any of the compliance legislation that's driving through the industry. So we will always be following that line. But as I say, we have to keep the shop open, and if a regulated customer wants to finance product from John Deere, we need to have a product that serves that customer.
Okay, great. So for Asset Finance Connect, as I said, we're doing a lot of work in this area. There will be more webinars. Please keep looking out for dates of webinars where we're going to discuss what the impact of the Supreme Court judgment will be. And there'll be a lot of information coming on the AFC website about that particular issue. So just before we close, then we're just 1 minute over. Could we have the results of the final poll question, please, Rosanna?
We can indeed. So the results of the final poll question: strongly agree at 10%, agree 30%, neutral just over 30% as well, disagree slightly under at 23%, strongly disagree much lower, 2.6%.
Okay, so it's a reasonably spread then. So a lot of interest in the connection between margin and specialization. So there's lots of other things we could have got into. We really probably could have needed a bit longer for this webinar, as always. But I'd like to say thank you very much indeed for Netsol for sponsoring the webinar. Thanks, Jason, to you personally for being involved and sponsoring and helping me with the content. And also I'd like to really thank the panelists, Graham, Steve and Ed. It's been a great discussion as always. And I'd like to thank also Rosanna for the poll questions and so forth and managing the controls. And finally, thank you very much indeed for the audience for listening. And please keep an eye out on the AFC website and for the dates and content of future webinars. And we'll see you all again soon. So cheerio. Bye-bye.
Thanks.
Bye.